Within the span of a single morning, more than $12 trillion in paper asset value was erased from global pricing matrices. Yet financial history makes one point unequivocally clear. Money does not evaporate. It merely transitions from one balance sheet to another. The critical question, therefore, is not whether wealth vanished, but where you were positioned within that flow when the shift occurred. Were you among those compelled to liquidate in order to secure dollar liquidity? Or among those quietly accumulating assets as prices were being forcibly compressed? This video does not prescribe action. Its purpose is to clarify what was structurally unfolding beneath that apparent displacement. If you opened price screens this morning and sensed that something felt off, that intuition was valid. Not because losses had just occurred, but because you were observing the visible consequence of a process that had already concluded. By the time the $12 trillion figure surfaced in headlines, the substantive reallocation of capital had already taken place. Markets were not reacting in real time. They were disclosing a completed transition. Situate yourself precisely at that moment, not inside a hedge fund's trading floor, but within a far more familiar environment. A phone vibrating, screens flashing red, financial applications refreshing incessantly. The US dollar appreciating, foreign currencies weakening, gold and silver selling off sharply. The instinctive response is to ask what just happened. The more consequential question, however, is what occurred earlier, outside your field of vision. In major financial cycles, markets do not collapse due to isolated news events. They fracture when liquidity becomes constrained, when the system begins prioritizing settlement obligations above all conceptions of valuation. In such conditions, the US dollar does not strengthen because economic fundamentals have improved, but because it functions as the ultimate unit of settlement. All other assets must orient themselves around that reality. When the demand for cash intensifies abruptly, financial institutions are forced into rapid response, not through long horizon analysis, but through immediate execution. Assets that can be converted most efficiently are liquidated first. Herein lies the paradox. Gold and silver, despite their classification as defensive assets, are often among the earliest to be sold in paper markets. Not because their underlying value has deteriorated, but precisely because they are liquid. It is at this juncture that widespread misinterpretation takes hold. Observers see precious metals declining sharply on screens and infer that capital is abandoning them. In truth, capital is temporarily consolidating within the dollar to relieve acute liquidity stress, without issuing any definitive judgment on long-term value. This distinction is frequently overlooked, and it is precisely where the narrative demands reframing. A closer examination of market mechanics reveals a pronounced bifurcation. Paper markets react almost instantaneously. Algorithms possess neither historical memory nor defensive context. They process inputs and execute instructions. Once a threshold is breached, automated sell orders cascade, triggering subsequent layers of liquidation. Prices decline not because additional supply has emerged, but because immediate selling pressure has intensified. Physical markets, by contrast, operate with inertia, slower, heavier, and grounded in reality. Gold and silver are not mined in response to intraday price fluctuations. Supply chains cannot accelerate within hours. Holders of physical metal, when confronted with rapid declines in paper pricing, typically do not sell. Instead, they withdraw material from circulation. Their decisions are not chart-driven. They are anchored in production costs and long-term demand. The divergence between these two domains is precisely where many participants sense that something is amiss. Screen prices fall, yet real-world transactions do not become easier. This is not simple manipulation. It is a structural phase mismatch between two pricing mechanisms subjected to fundamentally different constraints. Simultaneously, foreign currencies weaken against the US dollar. This is often compressed into a simplistic narrative. The dollar wins, everything else loses. Such framing is insufficient. Foreign currencies face pressure from short-term capital withdrawal and rising exchange rate risk. Gold and silver face pressure because they represent high liquidity instruments within the financial system. Equities face pressure as leverage is unwound and growth expectations are recalibrated. These movements occur concurrently, but they do not share a single cause. What matters is that beyond this phase, their trajectories begin to diverge. Financial history demonstrates that once liquidity stress subsides, markets re-establish differentiation between fiat currency, defensive assets, and risk assets. That inflection point, however, arrives only after instinctive reactions have largely exhausted themselves. The $12 trillion figure must therefore be interpreted accurately. It does not signify that cash was extracted from the system in a single morning. It reflects a repricing of financial assets on paper. The bulk of the perceived loss resides in market capitalization, derivative valuations, and price levels recalibrated to revised expectations. It represents a shift in risk perception, not emptied vaults. At this stage, a critical twist emerges. When valuation adjustments outpace collective perception, assets do not vanish, they transfer ownership. Participants forced to sell under liquidity pressure exit positions. Those insulated from such pressure, or prepared in advance, enter. No conspiratorial assumption is required. Modern financial systems inherently reward those who possess time and penalize those who lack it. What renders this phase particularly revealing is not the decline itself, but what fails to materialize afterward. When prices fall without a corresponding increase in physical supply, when holders refrain from selling, markets begin emitting signals that challenge purely price-based valuation models. This is where substantive questions arise. If prices are genuinely low, why does supply not flood the market? If the dollar is ascendant, why does demand for value preservation persist? And if capital merely changes hands, who was correctly positioned before the transition completed? The objective of this channel is not to forecast outcomes, but to situate the viewer within the correct structural context. Rather than asking where prices are headed, the more relevant inquiry is which pressures are currently governing market behavior. Viewed through this lens, movements that appear irrational often become intelligible. The analysis here focuses on the interaction between monetary policy, fiscal stress, and the behavior of defensive assets within a system where the US dollar remains the settlement anchor. The value added lies not in delivering predetermined conclusions, but in enabling viewers to recognize their position within the cycle, and to understand why collective reflexes typically arrive late. If you have followed this far, consider the question: are you observing markets through price or through structure? And do you believe capital is reacting to short-term fear or to obligations the system is compelled to prioritize? Share your perspective. Such discourse illuminates what price screens can never fully convey. $12 trillion did not disappear. It was repriced before awareness caught up. When liquidity pressure dominates, the US dollar assumes its role as the settlement instrument, while gold and silver, throughout monetary history, continue to function as stores of purchasing power when political and fiscal conditions enter periods of strain. This is not prophecy, but a recurring pattern. Paper prices react first. Real value is tested over time. And this is only the beginning. In the months ahead, as capital-intensive technologies, from artificial intelligence to space infrastructure, demand long-duration investment, the asset allocation narrative will continue to evolve. Markets may remain quiet initially, but the signals will surface. How do you believe this will shape the dollar, foreign currencies, gold, and silver in the next cycle? Share your view. This is Money Cycles, where we examine the structures and inflection points underlying volatility. If you seek analysis of this depth, you know where to find us. The future remains uncertain, but structural understanding fosters composure.